here this morning. So those are two to watch in Canada and the U.S. A little bit of red in an otherwise sea of green.
All right, and it is a lot of green out there, certainly, and we're joined right now by Diana Avigdor, Portfolio Manager and Head of Trading at Barometer Capital. Diana, good to see you this morning. What does this coordination of efforts on the part of the ECB and the Fed, et cetera, what does it do to your thinking about the market right now?
This is wonderful, as investors are very skittish about policymakers' responses these days, and every day is risk on, risk off, depending on the headlines out of Europe. So in the last couple of days, and yesterday's meeting of Germany, Greece, and France, and the news coming out that Greece is not leaving, Greece's exit is not imminent. So the market is now backing off from pricing in that risk. And we're happy to see that the governments are doing something to ease issues. However, it highlights the fact that there are some issues which they have to resort to this kind of thing. So on the one hand, it's great. On the other hand, it tells you that maybe there is some more stress in the system that we knew about or we were told about. That being said, this kind of volatility really renders the market into one big day trading event, and that's what's been going on in the last little while. As risk appetite has been coming on a little bit, really cash trading desks have been finding it extremely quiet. What has been working is ahead of this triple witch tomorrow, that perhaps hedgers are not going to roll their hedges, but perhaps just take them off. So volumes, while you see them pretty decent, have been even stronger in the derivatives markets.
That day trading aspect, Diana, is very hard for the individual investor to kind of face every day. The volatility is so huge. We want to show a chart because before this ECB announcement, you were looking at something I showed also last week, was this, you brought it to my attention originally, the Citigroup Economic Surprise Index, and it has started to turn up. We have it on the screen here. It's above its 50-day moving average. Yeah. It's below its 200. But what does this tell you in terms of expectations versus the economic data that's been coming out?
Yeah, look, this economic index, it's an economic surprise index. So it really doesn't give you a level saying that this is good economic data or bad economic data. It just tells you whether the surprises have been positive or negative. What that tells, the way I would look at it is as an indication of what's priced in the market. Because if expectations are high, then the surprises may be negative, and then the markets are not pricing in that. But if the expectations, because of the economic weakness that we've experienced in the last few months, and we've seen it in the economic data, have expectations come down enough that markets have priced in enough so that the surprises are now starting to be a little positive. And this morning, the surprises have been a little negative, so we need to see this continue. It's not to say that the economic data is going up. It just says that people are having their expectations in the right place, and that markets tend to lead that and price that in. We always talk about what's priced in the market as traders in order to pick our levels.
Has the move by the ECB and the Fed, et cetera, has it changed your longer-term outlook for the challenges facing Europe right now?
You know, this is out of our hands as long-term investors that would deal, for example, with fundamentals. These are issues that we are hostage to the headlines and the politics and the positioning that's coming out. That's why we're so macro. Every trade is the same. We spoke about correlations a couple of weeks ago, and I brought to your attention the chart, equity correlations, that stocks as they relate to each other. We're at a 20-year high at 95%. It means all stocks were moving in the same direction. That meant that the alpha that you generate out of picking your stocks is made for very patient investors because everything is a risk asset. Those correlations are now starting to come down a bit as maybe Europe is fixing its problems, or maybe coordinated efforts to fix the problems, and we can go back to the business of dealing with the stock market as a market of stocks rather than a global economic issue.
Diana, sorry, Diana. As a portfolio manager, as those correlations come down, where do you think you're going to find the best value? Because you have indicated previously that stocks are cheap.
Yeah, some stocks are cheap. We at Barometer do things a little bit differently. We're a very managed product. We're not so much buy and hold. We'll manage risk as much as we will manage the return. It's not about maximizing return and hence picking bottoms. It's about having a return, and at times you need to resort to managing risk rather than eking out the maximum return. So for now, we will still stay in capital protection mode. We still like yielding assets, risk assets, with the potential for capital gain going forward is going to still be attractive. Even when full-blown risk appetite returns. The market is about yield right now. People have been burned. They want to have some kind of security. They want to keep their capital. In terms of protection, we will keep some protection on for now. We will stay conservative. Markets have had a lot of serious breakdown. It will take a lot more work for technicals to turn around and show anything positive. Like I said in the beginning of this interview, the cash desks have been very quiet. Investors, real buyers outside of traders or short covering has not come to the market yet. People need to see a little more work done in order to establish whether this is for real or not, because we've had this before.
All right, Diana, great to hear from you this morning. Thank you.
Thank you.
Diana Avigdor, Portfolio Manager and Head of Trading at Barometer Capital.
And lots going on this morning. You're watching the first 15 on BNN. We're going to dig deeper when we come back into what's going on in these markets. They're to the upside, but maybe not as much as some people might have expected. We'll be right back.